What is finance and its types? Hello, and welcome to our channel Pursuit of Wealth. This channel is your ultimate destination for learning about finance and wealth, investing and crypto, informational and educational trends in finance management. If you are someone who wishes to become wealthy and looking for smart money management options, then we are fortunate to have found each other. What will happen if all your monthly income ends in the middle of the month? How will you manage if you have no savings from your annual income? Or will you be able to bear the loss if your small business keeps facing huge losses? Of course, it will be a difficult situation for all of us. But if you focus on the primary reason for this problem, you can easily avoid it. All of these problems occur when a person or a company lacks knowledge of money management. The knowledge of money management is known as finance. Once you know it, you will manage your finance more quickly and confidently. Watch this video until the end to learn about the concepts of finance, examples, and types of finance. Also, stay tuned for more amazing informative videos like this. In simpler words, we can define finance as: finance is a broad term that includes banking, debit, credit, capital markets, money, and investments. Finance refers to money management and the process of getting necessary funds. Money, banking, credit, investments, assets, and liabilities are all part of financial systems, and finance is responsible for overseeing, creating, and studying them. The basic strategies of finance depend on microeconomics and macroeconomics. Finance is not only related to money. Money is just for transactions. At the same time, finance is a broader term about the management and functions of financial sources. Let's understand finance with some examples. Many career paths and jobs perform finance-related activities. Some common examples related to finance are investing in the personal making for making more money, like investing in bonds and stocks, lending money to people to purchase houses, borrowing cash on behalf of a public company from institutional investors, personal savings in a high-interest savings account, composing financial and budget models through the use of Excel for cooperation, constituting a forecast for government expenditure and revenue collection, ratio analysis of the financial budget. Generally, keeping accounts well maintained, marketing for earning money, approving loans, and issuing stocks are all included in the financial activities. Sources of finance. Companies need financial services providers for their financial management. Some sources of finance for companies are trade credit. Generating a loan source for short-term finance is called trade credit. Companies having a solid market reputation regularly purchase their raw materials, tools, and other necessities on credit. Commercial banks. A vastly growing individual unit needs huge loans provided by commercial banks. Installment credit. In this method, assets are purchased, but payment is not made instantly. Compensation is paid in installments during the decided period with interest. Indigenous banking. These are not the latest financial resources, but these banks were the only source of finance in the past. People had to pay high interest rates at that time. Advances. This is the most accessible and most easily affordable source of finance. Companies take advances over orders from their agents and customers. In this way, they minimize their investment and make profits. Types of finance. There are three major types of finance: corporate finance, public finance, personal finance. Corporate finance. Corporate finance refers to the financial operations associated with running a business, often overseen by a division or department. A major corporation, for example, may need to determine whether to obtain more capital through a bond issuance or a stock offering. Investment banks may advise the company on such matters and assist it in marketing the securities. Startups may obtain funding from angel investors or venture capitalists in exchange for a stake in the company. If a business succeeds and wishes to go public, it will sell stock on a stock market in an initial public offering, or IPO, to acquire funds. In other circumstances, a firm may be attempting to budget its money and determine which initiatives to fund and postpone expanding its business. All of these choices fall under the purview of corporate finance. Components of corporate finance. There are 4 components of corporate finance that everyone should be aware of while conducting any form of study. The 4 components are operating flows, cost of capital, invested capital, and return on invested capital. Let's discuss these components in more detail. Operating flows. Operating flows are the natural flows that a firm experiences due to its activities. If you ask a business expert what their company's operational flows are, you will almost always get a range of replies. Net income is the answer for some. Others prefer EBITDA, earnings before interest, taxes, depreciation, and amortization, or cash flow from operations. While each of these measures has value and provides us with the information we need, they don't fully reflect the economics of what is going on in a business's operational flows. Cost of capital. The cost of capital is the second crucial aspect of corporate finance. The cost of capital is one of the most fundamental concepts in corporate finance, yet it is also misunderstood. Simply put, the cost of capital is the minimal rate of return demanded by the 2 most common sources of capital: debt and equity. Debt and equity investors put money into a company in the hopes of making a profit that is proportional to the risk they are taking. As a result, a corporation's cost of capital may be seen as a threshold rate that must be met, if not exceeded, before a company can claim to have produced shareholder value. Invested capital. The second important factor to examine in corporate finance is invested capital. If you ask business specialists what comprises a company's invested capital, you'll get several answers, just as you would with the idea of operational flows. Total assets may represent invested money for some, but it may also mean a company's equity for others. Both of these conceptions of capital, however, are faulty. Invested capital should be made up of long-term investments projected to provide a profit. Non-interest-bearing current obligations, such as accounts payable and accrued costs, provide some funding for total assets. As a result, a company's invested capital will be overstated if total assets represent it. Return on capital invested. The return on invested capital is the 4th and last key component of corporate finance. The NOPAT in a particular period is divided by the invested money at the end of the previous period to determine the return on invested capital. The capacity of a corporation to constantly surpass its investors' cost of capital estimates will decide whether it succeeds or fails. Public finance. Governments, like people, must distribute resources to various areas of the economy. Public finance is how federal, state, and municipal governments collect revenue and control spending for all of the services they give to the general public. One of the essential duties of a government is to generate money through trade, taxes, and loans, and distribute that income among different purposes, such as debt servicing, infrastructure development, and recurrent expenditure. Government agencies support a stable economy and avoid market failure by supervising income creation and allocation. Tax administration, debt issuance, budgeting, foreign trade, and inflation control are all governmental finance. These elements have a direct and long-term impact on business and personal finances. Public finance components. The primary components of public finance include actions connected to revenue collection, societal spending, and the implementation of a financing strategy, such as issuing government debt. The following are the major components. Budget. The budget is a blueprint that shows how much money the government wants to spend in a fiscal year. For example, in the United States, the President presents a budget proposal to Congress. The House and Senate draft laws to address particular areas of the budget, and the President signs them into law. Read a copy of the United States government's 2017 budget as issued by the Office of Management and Budget. Deficit or surplus. If a country's government spends more money than it earns in taxes, it has a deficit. A surplus exists when the government spends less than it collects in taxes. The national debt. If the government runs a deficit, where spending exceeds receipts, it will borrow money and issue national debt to make up the shortfall. The United States Treasury is in charge of issuing debt, and when there is a deficit, the Office of Debt Management, or ODM, decides whether to sell government securities to investors. Expenditures. Expenditures include all of the government's money on things like social services, education, and infrastructure. Much of the government's cost is intended to redistribute income or wealth to benefit society as a whole. Actual expenses may be higher or less than the budgeted amount. The collection of taxes. Tax collection is the primary source of revenue for governments. Governments collect sales tax, income tax, progressive taxation, estate tax, and property tax. Other sources of revenue include import fees and tariffs, and money from any non-free public service. Personal finance. Personal finance manages a person's monetary resources across 5 critical areas: income, investments, savings, expenditure, and assets protection. The objective is to make wise investment selections and create a safety net that will support the individual without limits or bad debts. Business owners should create a comprehensive personal financial strategy to protect themselves from unanticipated occurrences. Saving for retirement, for example, enables you to develop appropriate structures and avoid running out of money. Wealth transfer through generations, tax administration and compliance, credit cards, asset management, hedge funds, and debt servicing are all aspects of personal finance. Personal finance is suited to the individual's unique demands, whether short, medium, or long-term. 2 individuals may not have the same financial plan because of their diverse goals, earning potential, incomes, and periods. Paying off a loan, for example, may be your short-term aim, while establishing pension savings or a property investment could be another person's short-term priority. Components of personal finance: checking and savings accounts, insurance policies, stock market investments, retirement plans, social security benefits, credit cards and consumer loans. Also, income tax management are all examples of personal finance components. Financial planning, a dynamic process that involves continuous monitoring and reevaluation, is a critical component of personal finance. In general, there are 5 steps. Assessment. Simplified financial balance sheets and income statements can be used to assess one's financial situation. Monitoring and setting objectives. As time passes, your financial strategy should be evaluated and adjusted. Goal setting is done to meet specific financial criteria. Execution. Putting one's financial strategy into action typically demands discipline and effort. Many people seek the help of specialists, such as accountants, financial planners, investment advisors, and attorneys. Making a plan. The financial plan outlines how to achieve objectives. It might involve cutting wasteful costs, improving one's income at work, or investing in the stock market. Running a business without understanding money puts many things on the line. Aside from placing your firm at risk of bankruptcy, poor money management brings with it an excessive amount of unpredictability, which is undesirable for any organization. The amazing thing is that you don't need a finance degree to understand and apply these principles in your life. You can simply follow these steps to avoid getting yourself into financial issues. So, that's pretty much it for the video. Please subscribe to the channel, like the video, and press the bell icon for more amazing content about wealth management and finance-related videos. Success is coming your way. Keep your doors open. See ya till the next time.